When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thanks so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. We'll answer listener questions and finally when risk is appropriate and when it's not. My name's Jeff Shade, and of course, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program. Of course, it's Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
I'm doing really good. How are you doing?
I'm doing great, thank you. Appreciate you taking the time to be with us again today, as you do every week here for Premier Retirement. Of course, I want to thank our great listeners for joining us. Well, Jeff, the stock market just continues to rip here. It seems that the U.S. July inflation figure came out 2.7%. We still haven't had a rate decrease. Jerome Powell is dragging his feet a bit. Donald Trump is not happy about that. He's threatening him as a big loser. But the stock market, though, just when you think it can't go any higher, it continues to rip. Markets are celebrating, and it's driven these stocks to yet newer heights. How much higher can they go? Is there a cap on this? And if you're investing in the stock market, is this a point in time where you should be holding steady? Should you be buying, or should you be selling? What do you think?
If you follow the money's still going to the market. I don't get it. I still have some money in the market. I can afford to lose money. Most of our clients don't want to lose money, so they're a little bit apprehensive, and rightly so. I think we need to be very cautious at these levels. It is unprecedented that the market could maintain this much strength for such a long period of time. Typically, when you hit the peaks that we've hit for the last 2.5 years, as far as valuations, price earnings ratios, the fact that earnings aren't growing, the fact that GDP is still really anemic and it's barely growing as fast as inflation or population, neither one. I mean, both of those are actually exceeding the GDP growth, in my opinion, based on the numbers I'm seeing. But I don't understand how it can sustain itself other than the fact that there continues to be money. The rich people still buy stuff. The market makers are still continuing to drive the prices up just by setting higher prices on things. And in essence, it's kind of a way to manufacture fake wealth or just create net worth for people by just raising the price of a stock based on what somebody would be willing to buy it. If the market corrects and goes down 50%, you're talking trillions of net worth lost. Does that matter? I don't know. If people aren't spending it to live on and do different things, maybe it doesn't matter. I think the confidence is given that no matter what happens, it seems like either Trump can talk his way into making people believe that, everything's hunky-dory, but so did the last president, and so did Trump before that. All the presidents, they all want the market to look good. They all want to take credit for a good, strong market because in their mind, well, he was a great president. The market went up those 4 years. Well, he could be a horrible president and print money, do all kinds of things that are inflationary or detrimental to the masses in the long run and still not really be a great president, in my opinion. But nevertheless, the market is something that everybody watches. That's what they tout, and that's kind of the gauge that they use. So apparently Trump's doing a great job as president. I'm still very apprehensive. I mean, our people that have just 20% in our growth portfolio because they don't want to risk a whole lot we're hitting our annual goals just with very little at risk because the market's going good. But could we have made a lot more? Yeah. Well, are we bummed that we're not up 30 or 40% a year, or something crazy that we could have been had we been just all in aggressive stuff? Well, not if you can't afford to lose money. If you're young, you got a lot of time, you can ride this thing out. If you can be nimble and try to be what we call tactical and jump to the sidelines when it looks like there's a sell-off coming. And, just in the last few weeks, we've seen a few sell-offs where the market's gotten hit hard. And just in the next few days, somehow the market gets happy and it comes right back. And that's why everybody believes that don't worry about it, just hold on, it'll always come back. And so far in history, it always has come back. It's just sometimes it takes a month, sometimes it takes a week, sometimes it takes years, sometimes it takes decades. 2.5 decades it took after the Great Depression. Things were a little different then. I don't think money printing was as easy. I don't think there was as much news and hype and things that could get out in the news wires as there is today. But even not so long ago, after the dot-com bubble busted, every bubble pops, and we're in a bubble. It's just a matter of when it pops. But when that bubble popped, it took about 7 years for it to get back to even. And as soon as that happened, then the banking crisis happened. And It plummeted again and took another 7 or 8 years to get back to even. You look at the whole decade of 2000 to 2010, there was zero gains in the stock market. I mean, there's even some good companies right now. I was just looking at a chart, and I'll just pick one, and I'm not necessarily saying it's a bad investment or a good investment, or it's a low and it's time to buy, but United Healthcare has been in the news the last few years. And I just look at the chart, and it's back down because the CEO got murdered a few months ago. They've really not gotten back on their feet. A lot of things were exposed because rumor has it that this happened because they were denying claims and not doing their job as a good insurance company. They were just milking it for profits and being the total poster child of what's evil about capitalism. And honestly, I can't say I disagree with that. Not to pick them out from a lot of companies. Corporate America is not a benevolent society. It's all about profit. And if you get on the right side of the road and you get on the train at the right time, you can make money. But look at, United Healthcare, the price of the stock is the same as it was 5 years ago. So just because the stock market is healthy, it's really driven by some stocks. You've still got to be a good stock picker, or you've got to just ride the wave of the market and hold and hope or hang in there. That's why I like the principal protected products that we have, especially in this market. When the market's high, if it continues to surprise, then we make money. If it blows up, then we don't lose money. And you've probably all seen that commercial. It's like, if you're scared of the market or you don't have money to risk, then why not stay in the market and have gains that continue to go up with the market? But if the market crashes, you don't lose money. And why isn't that a good strategy, especially in times like these? I think it is. But then again, sometimes greed and the hype gets the best of us, and we throw a little bit too much at the risk proposition. And then when it goes down, we think, oh, well, it'll come back. And then it doesn't come back and it goes down. And then people, well, it's got to come back. It's got to come back. And, you never know. If it's money that you need, you might find yourself in trouble and wish you hadn't done it. But nevertheless, Trump's kicking against Powell. Obviously, they don't like each other. And I'm not sure that Powell isn't just doing this as a retaliative measure, not to lower the interest rates. I mean, lowering the interest rates, especially the short-term rate, which is what the government could use to finance debt if they wanted to roll it on short-term debt instead of long-term debt. But just because they lower the short-term interest rates by a stroke of the pen or just say this is what the interest rates are, that doesn't necessarily mean they still have to go out and buy the bonds, and they have to be willing to set a bond price that the Fed can deal with and the banks can deal with as well. The banks really don't want interest rates to go down because that's how they make their money. Rich people don't want interest rates to go down because that's how they're making returns on their safe money. My clients, most of the retirees that want to protect their money, they like high interest rates. It's the people that are buying houses and the people like in the government that want to pay off our national debt that are the ones that are most worried. I don't blame them. Do I want it to get better? I think there's a happy medium between where we are now and where we were. I would honestly hate to see interest rates go back to 1 or 0%. I mean, shoot, you want to put money safe in a bank and you can't make any money on it. It really leads only to one thing, is you have to buy up the stock market, overpay for things, and then you've got a new problem. You're probably taking too much risk on your money. So the next time inflation happens, the next time they have to raise interest rates, we have another 2022, only this time stimulus doesn't bail us out. It continues to fall, and maybe you lose 50% of your money. So we're definitely at the top. We've been at the top. We keep setting new highs. We set new highs about 7 or 8 months ago, just before the first of the year, actually about 8 or 9 months ago. And then the market kind of tanked and meandered along for a little while. And it's only been a matter of a few weeks that the market's hitting new highs. And so it's all the hype is new highs, new highs, new highs. Well, every crash in history started after we made new highs. Think of that, right? There's always been new highs before a crash. Does that mean it's going to crash? No, it just means that the new highs don't mean it's only going to the moon and it can't go back down. The fact is it can, and it probably will. And you just have to be ready and smart about how you manage your money. If you got 3/4 of your money in principal protected accounts, throw a quarter of it if you can afford to wait on it at the market and take advantage of these crazy things that are happening in AI, in energy, in nuclear, in gold and silver, in the mining companies that are making tons of profits because gold and silver prices have gone up so much. A lot of these big mining companies have not increased their overhead. In fact, their overhead has gotten down because fuel has gotten lower, and that's largely what runs the mining equipment and transports all this ore to and from the mines and the processing plants. So you're looking at the cost to dig hasn't really gone that much, but the cost of gold and silvers and even precious metals. So there's a lot of sectors that are doing really well. And just the idea that interest rates are probably going to come down, even though it's short-term interest rates may or may not have anything to do with mortgages. Somehow the home builder stocks are going crazy. Just a few days ago, several of the home builders were jumping 4 or 5% in a day on their stock value. But people are getting excited that, oh my gosh, people can afford houses. Builders are going to do better. I don't know about that. That all remains to be seen. But the fact is everybody believes it and everybody's willing to throw money at it. And if you follow the money, you can throw money at it too and maybe make a little bit. But again, if you throw money at it, you may make a little bit, but you could be losing. I have some clients come in and say, gee, Jeff, you should have told me that your aggressive funds beating the market and I should have had all my money in it. Yeah, you should have, but we could have had this conversation that Last year, you told me, yeah, I want to take some risk and the market's down 50%. And then you come in and say, Jeff, you're horrible. You lost half my money in my Fidelity account or whatever. It works both ways. And I'm always careful to ask people, how much are you willing to lose, or how much are you willing to bet, or how much do you know you're not going to need to use for the next 4 or 5 years minimum, maybe even 10. And if they answer that, they're okay with the risk, then we go into it. If they answer that they're not, which honestly, most of our clients who are retirees or pre-retirees would rather err on the side of caution and say, wow, I could have doubled my money in NVIDIA in that last few years, but you know what? I'm up 15% and I didn't take any risk over that same period of time, and I haven't lost any money, and my retirement isn't in jeopardy. So let's move forward and not worry about what we're missing. I think we have fear of missing out, the FOMO, and the fear of missing out seems to attack us at the wrong times. Like right now, I'm seeing more people saying, gosh, I wish I'd have been in the market the last couple of years. Can we get in now? I'm like, man, it was high then. It was high 2 years ago. It was high last year. Now it's even higher. Is it a worse risk? I don't know. If Trump can do all the magic he promises to do and keeps on delivering on good economic news, like inflation not going up as much as they thought it would, it's still over 2. The 2 is kind of the mandate level for not lowering interest rates. And Powell, to his credit, has held true to, he's practiced what he preaches. Trump doesn't like it because the paying off the debt and the debt increases based on interest is coming in on his watch based on what happened in the last administration, unfortunately. So he's trying to fix that. And he's trying to say, hey, Powell, you got to help me out here. And Powell says, why, brother? You call me names and you don't like me. Why am I supposed to just do that because I like you? The fact is they don't like each other. And I think it might be personal why Powell's dragging his feet. I don't know if Trump will fire him because of that. Trump appointed him. I guess Trump can put him in. Trump could take him out. Technically, but that's kind of an unprecedented situation. But I think he's already looking at the next Fed chair and trying to make some plans and hopefully work with somebody. He's hoping that he can work with somebody that can be more of a puppet on the Trump strings. But then again, if Trump's managing this entire economy and he seems to have a pretty good handle on what's going on, even with tariffs not hurting us, even with different aspects of the economy that everybody was saying is going to cause heartache and problems and this, that, and the other, hasn't come to fruition as far as what the opposition has said. It's all pretty much moving in the direction that Trump says. So again, I'll say what I've reiterated in a few of my last programs, and that is we may not have a recession if we can generate earnings that start growing as fast as the price earnings ratio is and get the price earnings ratio down by having these companies actually earn more money. And if the companies can earn more money, then we can avert the recession. But if the companies are going to stay stagnant and flat with earnings like they have in the last couple of years, then I don't see any choice other than to have a nice market sell-off, a correction, maybe even a nice recession to give us a chance to reset, rethink what values we put on assets and kind of have a restart. Meantime, put enough money that you can retire on, live on, and not worry about in stuff that isn't going to get caught up in all that mess. And meantime, if you've got a stomach for it, let's jump on the ride. I mean, the people that are on the ride in our office are pretty happy with the growth returns on our portfolio. Thing is most of them are too scared to jump on, and I don't blame them. In fact, honestly, I'm scared of this market. I can tout our successes and how well we've done in some of our portfolios and how some of our clients have done well. But honestly, most clients have been really conservative, and unfortunately, conservative investments are underperforming. So the conservative stuff is the one that's, this is gross, not making any money. Even dividend stocks are really not doing all that well lately. That used to be kind of a safe haven if you didn't want high risk. And it's kind of weird when there's only one place in the market to make money. It's just anything that surrounds tech and AI, and everything else lacks luster to down. So we're in an interesting time. Every new situation and every new investment climate brings new opportunities, new lessons, new energy, new opportunities to experiment, to learn, and sometimes, unfortunately, the hard way. And what I don't want is my clients to learn the hard way how risky this market is by putting too much in too late in the game and ended up getting hurt.
Jeff, I want you to give us a little lesson about PE ratio in just a moment. But before that, I want to remind listeners, you're listening to Premier Retirement with Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson. If you would like to get in and sit down with Jeff and talk about the market, talk about your portfolio and how to weather the rest of this year or the years to come, we invite you to do that by calling 520-780-9059. You can make that phone call right now at 520-780-9059. Leave your name, telephone number. Shelley will call you back and set up a time for you to come in and sit down with Jeff and ask the questions that are on your mind about the market, the economy, and what the future is going to hold for us. It's a casual conversation, no cost, no obligation. Again, 520-780-9059. You can also find out more about the firm online at premret.com. It's PREMRET.com. Jeff, we've been talking about the markets being overvalued, so I want to dive into that a little bit, talk about PE ratio, price earnings, and I've also heard PEG, price earnings and growth ratio. Can you distinguish between the two, and what is the PE ratio of these stocks in general right now as opposed to what it would be under normal circumstances?
Yeah, interesting. Price earnings ratio is how much you're willing to pay for a dollar worth of earnings. So if the PE ratio is 35, then if the stock is trading at let's just say the PE ratio is a 33, the stock is trading at 100, then the earnings are $3, right? So you're willing to pay $33 for each dollar of earnings. So you're making $3 on every $100 you've invested. That's a 3% rate of return. Not probably that good compared to even fixed interest at 5% with no risk. Sounds better than that, except that people are willing to overpay for the stocks. Historically, if you look at the S&P 500 and you look at all the different sectors in the market, sometimes, tech and other things that are kind of in high growth mode tend to lend themselves to a little higher price earnings ratio. But overall, it's been about the 15, 16 range is kind of a typical price earnings ratio if you look at history. Well, we're in the mid to high 30s right now. In fact, we're pushing 40, which has only been hit one time to my knowledge, and that was in the dot-com bubble before it burst. And so we're basically back up there at those unprecedented levels where people are willing to pay so much for stock and get very little return as far as their share of the earnings. And most of these companies, even though they're beating their earnings estimates, they've toned down the earnings estimates so much because of the tariff scares and just the economic news. They've really lowered the expectations to a point where all these companies can come in and beat expectations, and it makes everything, oh my gosh, they're making more money than they thought. Let's buy it for even more money than we thought. And it's already overpriced as it was. So price earnings ratio used to be a fundamental that mattered. I always used price earnings ratio to pick my own stocks, my personal portfolio, as well as the ones that I manage. It's really out the window now because it just really matters where the money's going. If the money's buying stock, it's driving the price up. But if the money's coming out of the stock, it's driving the price down. And that's really the only fundamental you can look at is just momentum and follow the money. Unfortunately, the degree in finance and business that I spent years to get doesn't come into play anymore because fundamentals don't matter. It's just a matter of look and research the good companies, research companies that have innovative technology, innovative products, uniqueness in the market, some sort of dominance in the market, some sort of growth trend. And at least if they're growing earnings and people are getting on board for the right reasons, then maybe we can get on the ride. The thing is in this market, you got to be ready to get off the train fast. It's ready to hit a wall. And as soon as you go around the corner and the wall's there, you better jump off the train. You go like, crud, well, that train, well, we might be okay. We're in a train and that's just a rock wall. We might be okay. No, we might not be okay. So, and maybe you will. Maybe there's actually a tunnel in the rocks that you don't see. But I think that's kind of where we've been lately is we go around the corner and we see this wall and go, oh my gosh, it's got to have a sell-off now. We got to jump off the train. And then we do. And there's, oh, well, it turned out it wasn't so bad. Or the tracks turned right in front of the wall and we averted the big mess again. We avoided it. It didn't happen. So I guess the market's safe now. I don't know. If you run across the freeway blindfold and you don't get hit, it doesn't mean the freeway's a safe place to run across with a blindfold. And right now I think we're running blind and we're running across the busy road or we're running in a train that's out of control. Does it mean it's going to crash? I don't know. But if we keep going on it, it's kind of like time will tell. Back to the price earnings fundamental discussion that you started me on is there's another aspect that I like is price earnings to growth. PEG ratio is price earnings to growth, meaning if we have a price earnings ratio of 30, in other words, if we're willing to pay $30 for a dollar of earnings, then if the growth on those earnings is going to be $1.35 next year, in other words, we have 30% growth, essentially we've kind of forced our PE ratio down. In other words, we maybe justify the stock being at a better price in a few years. And maybe we want to buy it now because we know a lot of people are going to want to own that stock for the future and maybe bidding it up. So that might be another good fundamental to use. Even if we have a group of 30 stocks that have tons of momentum, I'll go back and look at the fundamentals. And if that company at least is growing at a pace as fast as the price earnings ratio, even if the price earnings ratio is high, I'm willing to buy it. I'm way willing to buy it because that makes sense because there's fundamentals that you can add into the decision on whether or not this stock is only growing on hype or not. We have some stocks that have an enterprise value or a book value of what this company could actually be sold for. Maybe it's $5 billion. Yet their market cap, in other words, what people are willing to pay for stock is $10 billion. It's like, how in the world? So if you sold everything, you're only going to get half your money back. That sounds like a bad investment. Guess what? That data is available if you either buy it or look for it or know where to. I think you have to buy that kind of stuff, but we do because we're in the business. But those are the things that I think people don't look at. And the public investor, what we call the tourist investor, the non-institutional investor, the non-smart money investor, you could call them dumb money if you want, but it's the non-smart money investor, the non-inside investor, the non-savvy investor, the non-sophisticated investor is who's driving the market. And they're doing it based on hype, what they heard on Kramer, what the next hot stock is. Oh, we just heard that Robinhood just brought out a new IPO and it's going to the moon and it really has no earnings or no real value and it should be a $300 million company. All of a sudden it IPOs and it's worth $30 billion. I mean, how does that work? Price earnings ratio is outrageous because someday it might be worth something. So a lot of people are jumping on board with no ideas about fundamentals, no ideas about what makes a company run, what makes a company profitable or worthwhile. And some people that are starting companies are enjoying that hype because they own stock in their own companies. As long as they're cheerleading them up and people are willing to overpay for their stock, then, they can sell at a profit too. So again, the price earnings ratio is just one of many fundamentals that you can look at to justify some of the purchases that are made. And in our portfolio, I think one of the reasons that we're beating the indexes of late and significantly for the last several quarters, because we add fundamentals to just the momentum. It's not just about, the market's going up, let's jump in. It's, the market's going up. What are the 5 or 6 best stocks we can buy that are maybe fairly valued, that are actually increasing earnings and growing and justifying this market increase? And I think that's where you have to be careful is you add a little bit of fundamental analysis. And if you're not savvy enough to do it on your own, you don't have time to do it on your own. That's what, people like us are in the business for. We're advisors, and that's what we're supposed to do, is look at those things for you and help manage your money in an appropriate way and only take risks that you can afford. If you can't afford the risk, don't take it.
Jeff, you had mentioned that some stocks are powered by hype. I think the .com era, anything with .com was hyped and there was really nothing behind it. The new .com to me is AI, but it is different than the .com era, but still some people are buying it on the hype.
Well, it is all hypey. The thing with AI is it's a little more broad-based, I think, and just because it says AI doesn't necessarily mean it's good. There are some good ETFs and things that are pretty much broad-based as far as investments in AI, so you don't have to be quite as good a stock picker. You trust a fund manager or somebody to do the due diligence and research on what companies make more sense. But back in the .com era, it was like anything that had .com on it in the name. It didn't even have to have a product, a name, a purpose, earnings, a game plan, or anything. All it had to do is have .com in the name. And I think it was overly hyped, and there's probably far more stupid investments in the .com bubble than there is now, although maybe I'm just better at not looking at the stupid ones. There's another thing that's driving the markets, and that is crypto. I don't understand how somebody can manufacture a password and call it money, but I can't go and print fake dollars and spend them around town because it's the same thing. I go to jail for counterfeit money. They can create something, call it something different than a dollar, and it's not counterfeit money, yet it still drives prices up, causes inflation. It's a fake currency, fake economy, fake. It's the emperor's new clothes. It's not even real. It doesn't produce anything, but somehow it creates wealth because people are willing to trade actual dollars for it. And the people that are taking your dollars for it are the ones that are laughing all the way to the bank. So I would say it's not just based on the AI, but AI is very similar to the .coms because it is kind of a new era that we're seeing ushered in that's moving super rapidly, but it includes more than just the AI technology and the chips. When .com was just all about fiber cable and moving data to your house so that you can talk on the internet. Now, and there was some connection issues and things too, Cisco and some other companies did well because of that, mostly the chip companies and the fiber optics and that kind of stuff that drove internet. Now it's the AI, it's not just the chips and not just the programming, because AI can program itself now. You just have to just guide it and tell it what to program. It'll do its own. Crazy. But you still need the data centers. You still need to process tons of data instead of moving it through cables under the ocean like Global Crossing did, or fiber cables through the ground or next to railroad tracks and all that stuff. Now everything's pretty much moved wireless, but the energy it takes to drive all the chips and all the computer, data that's being processed creates heat. So you have to have huge cooling technology. You have to have nuclear energy to drive as much cheap energy to these big data centers as possible. You have storage up the wazoo. So there's several different areas, I think, and that's my perception. Now, of course, the .com hype was, I was only probably 10 years in this business that I knew anything, and now I've got 30 or 40. So I'm seeing maybe more broad-based participation in different sectors of the market with the AI, even though I think it is hyped. I think it may be a little bit ahead of itself. I think people are willing to pay a little more for stuff than for stock and things that they probably ought to, based on companies that are unproven. But there are certain certainties, and that is we need the data center, we need the storage, we need the chips, we need the room to put them in, the infrastructure to build out these big facilities, and we need the energy to produce it. So uranium, nuclear power, that's a cheap way to do it. Even the drill, baby, and get energy cheap so we can continue to focus on every aspect of energy that we can and we can harness to focus on this AI growth. Maybe actually a little more sustainable and maybe less problematic than the .com bubble, where you saw only 7 or 8 companies emerge as victors and everybody else is either a satellite company or still groveling around trying to get through it and trying to participate and be relevant some way. But then you've got these Magnificent Seven, which really was the product of the .com era that just blew those companies up, the Microsoft, Google, Meta, Well, back then, even some of the companies that are not doing so well now were pretty hot. Well, Oracle, that's still going. You've got Intel. Some of the big companies that were big back then are still pretty big, but you've got the Magnificent Seven that are just cruising on, and it's all because of that .com and the internet era really blew that door open so that these companies could thrive. I think we're going to see the same thing. I just think there's going to be more companies and more sectors of the market that's going to benefit by it.
Jeff, I want to remind our listeners that if you're looking to preserve your wealth so that you can have a better retirement, maybe you want to create an income stream that you can count on, reduce taxes, our Premier Retirement Roadmap just may be the answer for you. It's entirely complimentary. No cost, no obligation. You can get yours by calling 520-780-9059. Make that call right now at 520-780-9059. It could be the best call that you will make all year. Jeff, let's take a break. When we come right back here on Premier Retirement, we'll be answering listener questions and then later on discuss when risk is appropriate and when it's not, when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for making us part of your weekend. Of course, you're listening to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson. Also, with an office up in Mesa, you're traveling through Tucson today and you're saying to yourself, I live up in the Phoenix area. I'd love to talk to this guy. Well, we can also meet you in Mesa if you want. If you'd like to call us and schedule a complimentary session, we call it the Retirement Roadmap. No cost, no obligation. 520-780-9059 is our telephone number. Again, it's not going to cost you a dime. 520-780-9059. Also, if you're listening to us on the radio, reminder, we're on 4 times a week. Saturdays at 7 a.m., 9 a.m., and also 1 p.m., and Sundays at 11 a.m. and as always, 24 hours a day, 7 days a week, 365 days a year. You can hear our podcast. Wherever you get your podcast, search for Premier Retirement with Jeff Hogan, and we'll be right there. Okay, Jeff, I always enjoy the listener questions. Our listeners talk back to us. We're going to start off today with Veronica listening to us in Marana, and Veronica says, my husband is 65 and I'm 62 and both recently retired. We have some cash that we'll be using to bridge the gap before we start taking Social Security. I don't want to drain all of our cash reserves, so I'd need to withdraw from either our Fidelity QQQ account or 401ks to supplement the cash that we already have. One of the advantages of withdrawing from our 401k is that we'll be in a lower tax bracket during our gap years. I'd love to hear your thoughts or recommendations on what to do.
Well, I'd like to see your whole picture before I just recommend that. I might think that you're draining way too much of your cash reserves. You don't want to drain all of them. How much is there in the QQQ? How much is in your 401k? Do you still have liquidity? Do you want to convert some of that money to an account that can't go down? Qs have been going crazy the last few years. You never get hurt taking a profit. You might be smarter to lock in profits on that and take some of that money out since you've already made a ton. You can live on the profits, no big deal. You're already paying taxes on them. Well, actually, if it's a QQQ, it's an ETF, so you don't have to pay taxes till you sell, but you pay taxes as you pull those out, capital gains taxes, if you've held them a while. And then you've got the 401k, which is going to be taxed at an ordinary income tax. And I would say if you're going to be in a low tax bracket, that probably makes sense, but it probably makes sense to pull more out of the 401k than you need to live on and reinvest the rest, either directly transfer to a Roth IRA and pay no taxes anymore, pay taxes now, never pay tax again, or include a LIRP. You're at the age where if you're in good health, a LIRP might be a perfect opportunity for you. I know some people have been telling me they've hearing things on the radio about, LIRPs aren't what they're cracked up to be. If you see somebody telling you LIRP's good, come here. We just want to invest your money and take fees forever and risk it forever. Well, whatever. I mean, to each his own. But the fact is LIRPs do work and they do provide tax-free income. And the difference between that and a Roth IRA that some people don't understand because they don't use them, never used them. Maybe they don't have affluent clients that have tax problems, so have never really applied the strategies. But I found that the product they call the rich man's Roth, which is the LIRP, life insurance retirement plan, is typically used for wealthier people than the typical client that most financial planners deal with. However, what I found is that even regular normal people can still enjoy tax-free income, lower tax brackets, and instead of drawing the money down from a Roth and having it never be there again, the nice part about LIRPs is that you don't actually draw the money out. You borrow against the ever-growing compounding interest in the Roth account. And you can also use principal protected strategies. So when the market does well, you make double-digit returns on occasion. And when the market does bad, you never lose a dime. You don't lose any money on your cash value. All you have to do is just buy a little bit of insurance that costs similar to what a fee would cost of an advisor or a fee to a mutual fund company. So it's not like they're expensive compared to other things that you would purchase in order to get some sort of a financial advantage. But consider doing some conversions either from 401k that's going to be taxable while you're in that low gap period, is to convert more of your IRA or 401k money than you need to live on and put it in a place where you can live on it later tax-free. You always want to pay taxes at the lowest tax bracket possible on the least amount of money possible. If you wait until you're in a higher tax bracket, till you're in your 70s and have to pull money out of the 401k or other qualified assets, meaning IRAs, et cetera, those things that you've saved for retirement that were tax deductions when you bought them, but now they're going to be a tax problem when you take the money out. Wouldn't you rather pay taxes now on, let's say, $1 million over the next 5 or 10 years and be done, rather than pay taxes at a 25 or 30% bracket over $3 or $4 million in total income that you pull out of that account between now and the time that you're 100 or the time that you pass away? You'll pay a lot less in taxes, get rid of the burden now. You can control the tax bracket now. I doubt, and most people will agree with me, I doubt, and they will also doubt, that tax brackets or tax rates will go down more than they'll go up. I think over the next few decades, we've got a lot of budget balancing to do, a lot of financial mistakes, unfortunately, or financial irresponsibility that the government continues to do. That puts us kind of in a rock and a hard place where we're going to have to supplement the draining of our Social Security. We're going to have to supplement just the debt servicing, our own debt. All the problems that basically nobody thought would be a problem are going to end up being problems, and we're all going to have to pay for it. Guess how they pay for it? Through taxes. So if you can create a bunch of tax-free income streams for the future while you delay your Social Security as much as possible, get a biggest check as possible as you can, because it does have some tax benefits to it, especially with the new big, beautiful bill. But I think a good comprehensive plan showing you how to make the best of your tax situation would not only save you in taxes, but it would increase your cash flow now and for the long term. So you're the perfect kind of a person I'd love to show how our plan works to, because you've probably not been exposed to it. If you're just doing the QQQs, that's kind of like indexing, and the 401k doesn't give you a whole lot of choices. They certainly don't do comprehensive planning or even tax planning. All they say is, don't pay tax now, and when you pull it out, we'll have a mandatory 20% withholding. Good luck, see ya. And that's about it. So if you want to convert that to a plan that you can feel comfortable about getting through the next few decades of your life rather than just the gap between now and Social Security, then I think it'd be incumbent on you to find an advisor that does comprehensive planning, either us or someone that you've heard that you like. Hopefully you listen to us because you like us, and maybe you'll come by and have a chat and find out what we can do for you.
Veronica, we appreciate that question. Thank you for listening to us in Gladden Farms there in Marana. And if you'd like to talk to Jeff, 520-780-9059 is our telephone number. We would love to help you out. No cost, no obligation. Next question is Bill in Green Valley. Bill writes, I've yet to hear any financial radio hosts talk about charitable gifting annuities in retirement planning. For those of us who know that charitable gifting will be part of our estate plan, a charitable gifting annuity is a great way to secure guaranteed income and leave the residual to charity. Additionally, there are tax deductions at the time of funding, and much of the income is tax-free. I know that you're a proponent of charitable gifting in an estate plan, and I'm curious what you think of using charitable gift annuities.
Well, I like them, and the reason that it probably isn't why a lot of us spend time on the radio is we're not doing just a high net worth presentation. I mean, we're talking about a lot of normal people that don't have a need for charitable gifting or estate tax planning. I mean, if you know you're going to be using charitable gift annuities, honestly, you're in less than 10% of the retirement community, probably 1%. So congratulations on being in a position not only that you could benefit by charitable gift annuities because of the tax breaks. It probably means you're in a high income situation, or you've sold some property and want to have an offsetting tax deduction on that, or that you have a large estate and you don't want to pay some estate taxes. One person that came by bought one really prominent, big, Magnificent Seven stock about 40 years ago and turned a couple $1,000s in IRA contributions in $25, $30 million. There's a problem there with taxes when you have to pull that out, RMDs and things like that. And then leaving those assets to just a few kids and having them have to spend those dollars in a period of 10 years or less, you're going to put them in a 40% tax bracket on ordinary income for the rest of their lives too. And if you have kids that work and are successful that are probably in a high tax bracket themselves, then yeah, charitable gift annuity is great. The cool thing about those is you only have to actually leave 10% of the amount that you gift to the charity. The rest of it can be used for income over 40 or more years. You can do it over generations, not just 10 years. You can turn a $25 million estate into $100 million in distributions and possibly get a few $1,000,000 in tax deductions that you can pass through on a big sale of a property, or even on your own RMDs for the next few years, required minimum distributions, especially if they're large, because you have a huge amount in qualified assets. I know people that have done trust for 401ks and done some fix and flips and all kinds of creative real estate investing. And you don't see very many IRAs and 401ks or personal retirement plans that are worth tens of millions of dollars. But when that happens, that's when charitable gifting becomes a smart idea. And it's not necessarily smart to wait till you die to do it. Although you can set up a charitable gift annuity that's already set up to be funded with qualified assets so that you only have to take out what you need now. But rather than give your kids that big, huge tax bill or a 10-year forced payout that'll cause them problems, then you could actually create a trust and then create the charitable gift trust out of it. Now, if you have a favorite charity that you know is going to be around a long time, and I would caution you on this only because I used to 20 years ago, I was involved with the head endowment council for Boy Scouts of America. It was a good friend of mine. And then all of a sudden, you commit to leave everything to Boy Scouts, and then you find out they changed their mission, changed their goals, changed their value system, and they're not the organization that you had just committed to leave all your finances to and let them handle this charitable gift annuity that you've given millions of dollars to or thousands of dollars to, whatever. And then they don't carry on your wishes because they spend it on things that you don't approve of. It may be smarter to do that charitable gift annuity more on a managed basis, on a more generic basis, where it's a charitable gift annuity. You could do it through donor advised funds. You can build your own, where it ends up giving it to the charities of your trustee's choice upon your death through your regular trust. So there's a variety of different layers of things that you can do. Bill, you're probably not the only high net worth person that probably needs a charitable gift annuity. I appreciate you bringing it up, but it isn't something that the mainstream probably knows about or could utilize. And 90+% of our listeners are probably more interested in finding out, how do I protect against losses, still make money, and how do I make my income last? And what is a LERP, and why do some people think it's bad and some people think it's good? And will it save me enough taxes to make it right for me? And those are the kind of things that we talk on a regular basis because 90% of the people that come in are asking those questions. But I appreciate the change of pace. It was nice to revisit that. Years ago, before the estate tax limits were so high, it used to be that we talked about charitable gift annuities all the time. I'm an old timer, so I actually know about them. I used them early on in my days when I actually worked for an insurance company before I decided to combine my brokerage experience with my insurance business and create more of a comprehensive financial firm of my own. We learned about that stuff, and we learned about annuities. We learned about giving with charities, and I worked with some head endowment officers of big charities, including Boy Scouts, and did some work there. So those are certainly valid questions. If you do have an issue where either you don't have children, you want to leave things to charities, why not get some tax deductions now on some income or offset capital gains instead of wait till you die to have it all work out then and end up living on less because you felt like you were pinched or that you didn't want to pay taxes on the money you lived on or as much taxes that you wanted to live on, and you didn't use some of the tools that are out there. Yeah, Bill, that's a great tool, and it can be utilized not just for rich people, just like I mentioned LERPs. They're not just for rich people, even though they call it the rich man's Roth. Normal people can use them too. Normal people can use charitable giving. We like donor advised funds to do that. It keeps it a little bit more flexible for the small estates, but you can get pretty elaborate with them if you want to, and depending on the complexity of your estate and what your plans are.
Bill, good question. Thanks for listening to us in Green Valley. And of course, we'll send you out Jeff's book, Retirement the Road Ahead. Our number, Bill, give us a call here at 520-780-9059. We'd love to talk to you. Next question is Ralph listening to us in Vail. Ralph says, I'm 65 and in good health. I'm getting ready to retire next year and have realized that I'd like to have a little more money than I currently have. I'm looking for some supplemental retirement income that is preferably tax-free. I've heard you talk about LERPs. Is that something that I could use, and how would it work?
Well, you're 65. You're still at an age where it would work. If you're in good health, it would work. Now, what I don't know is how to fund it. Do you have money you've already paid taxes on that you could just move over? LERP is kind of like a tax-free bank account where you get to keep your money in there and you never actually spend the money in the bank account. You just borrow against the bank account. Kind of like how if Elon Musk wants to go out and buy a yacht, he doesn't sell a whole bunch of X stock or Tesla stock and pay taxes at 20% plus on the stock so he can go buy a yacht. What he does, he just borrows $1 billion from the bank against his stock. And guess what? He saved $200 million in taxes, 20%, right, on that billion. But rich people use it all the time. They borrow money. Well, why not create an asset that you never actually deplete, but it grows based on principal protection. It grows tax-free. Anything you borrow is tax-free. And when you die, it passes to your heirs tax-free. I mentioned earlier, there's people out there, oh, don't get a LERP, they're horrible. Really? Well, it's obviously you don't know anything about them, or you don't like tax-free income, or maybe you just don't like the fact that you don't get a fee on it forever, like managed money or some of the other things, variable annuities and some of the stuff that pays ongoing income. And maybe it's not part of your business model, but it doesn't mean LERPs don't work. LRRPs work great. You basically buy a death benefit, you spend it during your lifetime, and instead of being death insurance, it becomes life insurance. Life insurance, death proceeds are tax-free. Why not buy $1 million in death benefit, pay $200,000 for it, and spend all $1 million before you die? Tax-free. It may not be quite that simple, but that's the concept. Could you do that in a Roth IRA? I don't know. Would it pay 3 or 4 times what you put in over that period of time? Maybe not. Would it be considered provisional income? Maybe, maybe not. It isn't now, but it could be. That could affect your taxes on Social Security. It could affect your IRMA on your Social Security. There's a lot of things that outshine Roths for tax-free income with a LRRP. But as a backup plan, if you're listening to this question and you're 65 and you're not in good health, and you're like, well, shoot, Ralph can do it because he's in good health. I can't because I'm not. A Roth is the backup plan. But if I do the math and historical returns, unless you really beat the market, a Roth probably won't supply as much income as a LRRP will and give you as much tax-free benefits over time. So that's why I like LRRPs. I can't guarantee the Roth results. I can't guarantee the actual income from a LRRP, but I can guarantee that the account continues to grow and doesn't lose money, and you can borrow against it. And when you use money on a LRRP, you don't take it out of the account. That I can guarantee. That's how it works.
Ralph, thanks for that question about LRRPs, and we appreciate you listening to us in Vail. Of course, you will get Jeff's book, Retirement, The Road Ahead. You're listening to Premier Retirement with Jeff Vogan, founder and president of Premier Retirement Planning in Tucson and Mesa. Once again, if you're looking to preserve your wealth so that you can have a better retirement, if you'd like to create an income stream that you can count on, maybe you want to reduce taxes, Premier Retirement may have an answer for you. It's called the Premier Retirement Roadmap. We're offering it today, no cost, no obligation for our loyal listeners. All you've got to do is call 520-780-9059 to get your retirement roadmap. Again, no cost, no obligation. If you're looking for a conversation, the sort of conversation that you may not be having with your other financial advisors, we invite you to call us because we're just a little bit different here. We listen to you. 520-780-9059 is our number. You can also find out more about us online at premret.com, premret.com. Jeff, I want to talk about our last topic here, and that is when risk is appropriate and when risk is not appropriate. I think that is one of the biggest questions among taxes, certainly, that we get here at Premier Retirement, and that I get when I talk to other people on the street, is how much risk should I be taking in my retirement portfolio? Let's say that I'm 65 years of age. I may live maybe another 20 years. I want to have a good retirement. Can I go without risk, or is risk appropriate? I know it's a tough question to answer, but what do you think about that question? Risk appropriate and when it's not?
Well, it's appropriate on the money that you don't need to use. Some people have this old adage, yeah, well, if I have half my money in bonds and half my money in, okay, let's go back to 2022 and pretend you have $1 million. 50% of it's in bonds, $500,000 in bonds, and $500,000 in the market. And let's say you decide, oh, I don't want to spend my money in the stock market, and I've got to live through 2022, pretty much the whole year while the market's going down 20%. Well, guess what else went down 20%? Bonds did. Bonds went down, and they're still down 20 to 25%. So if you're living on bonds and they say, well, let's wait till the market gets back to even, and it took, two and a half years from the peak to get back to break even again. It was just last year that it happened. During that 2.5 years, you're locking in losses on either part of that portfolio. So I think you need not just the cash and bonds, maybe some cash, but what I like to do is have enough money before you start putting money at risk. You have enough money in income generating products. I like the index annuities with income riders that guarantee enough income that all your bills are paid. I'd rather have you, let's say you have $250,000 in aggressive stocks and you have $50,000 in something that's generating $60,000 a year in income. So you don't even need to touch that $250,000, $300,000. If the market crashes, so what? You're still getting your $5,000 a month to live on. If you have $1 million, the rule of thumb is 4% rule. So you're getting $3,000 to $3,500 a month to live on, and you're taking risk. And when the market crashes, you lock in losses. And that's the reason you can only take 4% of your money out, because you keep on having to lock in losses, and it doesn't grow back to $1 million as fast as the market gets back to $1 million because you spend a bunch of that money. Might take you 5 or 10 years to get back if you even do, but probably you're not going to get back to even because you're spending money on a monthly basis from asset classes that go down in value. My opinion is if you're going to even think about income, make sure the income is being derived from products and accounts that are principal protected, that don't go down in value, because you never want to lock in a loss. And by the way, if you do that strategy, you don't have to average 10 or 15% in the stock market to make it work. You can average 6 or 8% in overall earnings. Maybe you earn 10 or 15% on the market stuff, but you never have to touch it. So that's going up and down, while maybe you're making 4 to 6% on the money that you're spending. By the time, that account that you haven't had to touch is 20 or 30 years old, maybe now it's back worth $1 million. So even if you've spent down your money, you've still got a net worth of $1 million. You've been living on a 6% spend down instead of a 4% spend down. Again, risk is really relative to each person's situation. I think once you have all your income needs met, then it's time to start thinking about risk. But don't start thinking about how can I allocate my risk assets into a way where I should be able to take enough income. As long as everything works out okay and averages out, I'll be okay. The fact is, averages don't matter. It's the sequence of returns and the sequences of investments that make up those averages that matters. And when you're taking income out, you're playing with the sequence of returns. You're not playing with the average rate of return. Stock market averages 10% over time. Well, how come the 4% rule's in place where you can only take 4% out? Well, if it averages 10, shouldn't you be able to take 10% out? That's what an advisor told Norm. The famous story that I always restate, it was in my book, and it was, how I learned the hard way, how devastating the market can be, or the market volatility can be on an income plan. He had $1 million. He was a engineer at a prominent chip company, and his advisor says, Norm, the stock market averages 10%. You can take $100,000 out, no problem. He says, okay. So he did. The market crashed 80% the next 3 years. It was between 2000, 2001, and 2002. By the time he got second jobs, took Social Security, and started spending less, he was down to about $400,000 when he finally met me in 2009, right after the market crashed. And by the way, he was back down to about $250,000, wondering why a guy in his 70s who used to have $1 million, who was told by a financial advisor that you could spend the average rate of return, isn't working. And the fact is there was really no way I could help him. So again, you have to remember, sequence of returns matter. Solidify your income needs first, then worry about risk, especially if you're talking about retirement income. And honestly, the mainstream guys out there, and call them my competitors, and I don't think we compete with anybody, honestly, I don't mean to sound arrogant, but we have a different style. We have an approach of, you've worked hard for your money, let's protect it. You've worked hard for your money, let's not squander it, let's not risk it. Let's make it work for you. Your money is your money. Keep it that way. It's not the market's money. You acquired retirement assets by having risk in the market. Well, remember, you had a job that paid all the bills during that period of time. The stuff you put in the market was the extra money. In retirement, it should be your extra money as well. It shouldn't be the money you plan to live on. It never was the money you lived on. So why should it be now? It should be the money that you take profits from, that you convert to income streams that you can count on, like a salary from work, or like a pension that you may or may not have, like Social Security that hopefully will be there, but may not. And so ensure your retirement based on those assets that you've worked hard to acquire. Set up an income stream you can count on, and decide what the appropriate amount of risk is. And don't deviate from the plan, and you'll be fine.
Jeff, I talk to people all the time about risk, and they say, I'm 65, 70. I've worked 40 years for all of this money. I don't want any of my money to be at risk. I'm going to put it into a CD or a money market. Is that a big mistake when you're that age?
Not if you don't need it. I mean, in my opinion, risk is only on the money that you can afford to lose. And if you've saved a certain amount, and there's a lot of people that haven't saved enough where I think they should take risk. They're not rich enough to be in the market. However, you can still have market upside and have average rates of returns much greater than CDs by using indexed products that have principal protection. If you save a little bit of taxes along the way by using Roth IRAs and LERPs, you don't have to make as much money either. And that might also be a way that you can make your money stretch. But keeping up with inflation is only a matter of importance if you're trying not to spend down any of your principal. But if you saved $1 million or a couple $1 million for retirement and you don't want to take any risks, if you have $2 million, you can spend $100,000 a year for the next 20 years and make no interest. If you make 4% interest, that money will last you 30 years. I've got plenty of clients that have more than a couple $1 million, have zero in the market because they just don't feel like it. They don't have to. Why even risk it? Why even have a reason to get up and be stressed out and look at the market and go, oh my gosh, the market's down. I might have lost some money on a stock. If you know every asset you have can make some sort of interest and that you're not going to run out of money, you're not trying to make your kids rich when you die or give it all to a charity to change the world, and you just want to make sure you're okay, I have no problem with somebody that just wants no risk. I like that client. They're less trouble. They are no worry to me. And honestly, I don't like people coming and saying, hey, Jeff, I don't want to worry about my money. I want you to worry about my money. Guess what? I don't want to worry about your money either. I will worry and I will watch it and I will manage it, but I will manage it knowing that you've got the income needs, that you're not going to call and say, oh, gee, Jeff, we've got some surprises that we're going to have to liquidate our entire investment account. And I know it's down 50%, but boy, it sucks. We're going to put you in a place where your income is met and you have that buffer fund for the emergencies, and you don't have to lock in losses on those assets if you structure it right. So again, everybody's risk tolerance is different. Some people love to have risk. Some people have big pensions and they have tons of income and they can put all their money out there at risk. But other people have to live on what they've saved and don't have a choice. If it's within their framework of peace of mind and their needs, they may be better off with no risk. So everybody's different. I like to be the no risk first and the risk only when appropriate type of guy. And I think I convey that on this radio show. Hopefully I do, and hopefully I did today.
Jeff, we're running short of time today, but before we go, once again, I want to remind our listeners that if you're looking for a financial advisor who has the depth of knowledge and the tools in the toolbox that Jeff does here at Premier Retirement, we invite you to give us a call. 520-780-9059 is our number. You can make that call today if you want. Leave your name and telephone number, and Shelley will call you back and set up this appointment with Jeff. No cost, no obligation, certainly. 520-780-9059. We would love to talk to you. Jeff, out of time for this week. Thanks so much for your time, but most importantly, as I say every week, thanks a lot to our listeners here in the greater Tucson area for joining us. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.